2008 will be the worst year in the market in 7 decades. And given what's gone on, and that's been well documented, you really have to take a look at some of the big implications going forward. And there are going to be some major themes that you're going to have to think about in the terms of the investment environment. And that means beyond just the companies, beyond just price earnings, and you have to incorporate those into your thinking. So first one of those is really going to be the issue of debt and leverage. Given what we saw in 2008, you can definitely say that debt, if available, is going to be much more expensive, and it's going to be on much more punitive terms. So that means if you can get it, you're going to be paying a lot more for it. And that means companies that rely on debt for their growth are going to have a great deal of difficulty going forward. So you have to incorporate that into any valuation you make for any equities, and be careful with companies that have large amounts of debt that are coming due and have to be renegotiated in the next 18 months. The second thing is to focus on is economics in general. There's going to be we're going to be revisiting all of the economic theory here over the next little while, and in particular free markets. I mean, the free markets clearly weren't functioning as well as they should have, and they're going to be looking at how decisions were made and what can learn from them. If you look at some of the appointees in the Obama cabinet, a lot of them come with backgrounds in behavioral finance, and I believe that behavioral economics is going to be form a bigger part of how policy is framed. The third thing to really look at is really and to consider is the issue of productivity. We've had a lot of the benefit that we've received as a society over the last 20 years has been the continued productivity increases. But now that governments are playing a much, much bigger role in the economy, that generally means lower productivity growth. And the reason for that is that you have less competition. To the extent that you don't have that cutthroat competition, people don't have that incentive to make those productivity gains. So that it's likely productivity growth is going to be a lot lower, and also baseline GDP growth will be lower than expected. So if you're looking at sort of 3% growth rates going forward, I would modify them down to 2.25% and going forward, and change the way you evaluate investments by incorporating a lower baseline forecast. In conclusion, the way to think about things is that there's been an extraordinary amount of panic. And whenever you get panic or you get a crisis, there's always opportunity. And how you identify these opportunities is not just by using conventional metrics, but you have to incorporate some of these other factors in. And when you incorporate those, along with detailed research, you unearth really good opportunities. We've seen quite a number of good opportunities in this market that are consistent with a lot of these with a lot of these changes. And as long as you recognize those changes are coming, you're going to do well in 2009.